In business, Indonesia's central bank facing closer scrutiny from Parliament after revisions to a sweeping financial sector law was passed. Legislation allowing lawmakers to evaluate the performance of Bank Indonesia and other key institutions, including the Financial Services Authority. Indonesia's finance minister saying earlier the bill would contain a mechanism to remove members from the central bank's board of governors. The change is adding to worries about potential political interference. Although the finance minister has pledged to uphold central bank independence, the revisions also put in greater emphasis on Bank Indonesia's role in supporting economic growth. The law amendments come as investors grapple with growing uncertainty over Indonesia's economic outlook. The currency, the Rupiah, has weakened past a key 18,000 level to a record low against the US dollar, while the main stock index has fallen to a near 6-year low. Concerns fueled by changes to commodity export policies, potential pressure from ratings agencies, and rising oil prices due to the war on Iran. For more analysis, Radhika Rao, senior economist at DBS Bank, joins us live from Singapore. Ms. Rao, elected governments do pick who sits on the central bank board, or certainly the central bank head himself. Elected governments also decide largely the mandate that the central bank should meet. So why is this causing such concern?
Hi, Vesu. So certainly what you've seen is that I think a couple of things in this finance bill that's been discussed, right? So the first one being that the mandate of the central bank, especially on the policy making front, will widen. It already has inflation and currency stability, and now you're going to also see a real growth or real sector emphasis as well, essentially to mean that if growth is slowing, the policy would turn supportive. Apart from that, there are a few other nuances. The parliament will get greater oversight on the board, and the others being, that the state investment agency that's been set up last year that might also issue some bonds and thereafter. So there are a few more parts to this entire finance bill. But certainly, to your point, the part on BI's mandate being expanded and greater oversight has caught the market's attention as well. I would say, greater oversight certainly helps because, if there are any governance issues, any implementation issues that get taken care of. But of course, the authorities do tread a very thin line insofar as, they have to just make sure that these decisions that are taken or the oversight is not really influenced by what is happening on the monetary policy front. Insofar as those two can be kept separate from each other, I think the markets would take solace from that. But at this point, of course, they're looking at this bill being passed quite closely, which in a sense will really widen BI's mandate to include a lot more objectives than it has currently.
Well, central banks look at price stability, look at interest rates, but surely they also consider growth at any point. And it's been part of the mandate since 2022. This is just underscoring the fact that central banks need also to factor in growth when they make decisions on monetary policy. Why concerns now in this administration?
I think it's, first of all, it's rightly, as you mentioned, it back in 2022, you really had seen economic growth becoming, and then there was a conversation that the unemployment rate could also become a part of the formal mandate. I think all of this is essentially telling you that not only will there be one side focus on price stability, but on economic conditions broadly. But when there are more the objectives, you've really, some of them tend to conflict with each other, especially in a time of crises. And I think just as present when we have the West Asia conflict raging on, we've got inflationary pressures and fiscal implications for many of the countries in the region. It does become harder to draw a line between what would you get precedence to. Would it be growth or would it be inflation? But given, where the currency is in Indonesia's case, and inflation is picking up, gradually, I think the focus of the central bank has been on raising rates. They've already done about a 50 basis point bunched up hike. We do think they could go ahead and hike some more as early as this month. So putting these things, some of this could conflict with the growth agenda, but I think it really depends on the context and the circumstance that the decisions are made in. During crises like the time we are in right now, I think it does make sense to provide price stability and currency a lot more weightage vis-a-vis growth. Because in Indonesia's case, again, growth, at least in the first quarter of the year, held up well. For the entire year, we still see growth holding up above 5%, just above 5%.
All right, and a final question. The sense of crisis is certainly not helped by that war on Iran. Indonesia, unlike other countries, not raising fuel prices, so it's going to be looking to some quarter to fuel, to I suppose, fund its fuel subsidies.
Certainly, the decision does become difficult, especially if so in Indonesia's case, for example, subsidized as well as widely used unsubsidized fuel variants prices haven't been increased. What typically happens is when prices go up too much globally, you try to see some of that pass through to domestic prices, so demand generally adjusts accordingly. At this point, that has not happened, which means for the fiscal books, because the government is the one that has to take the burden of the extra subsidies, the room will have to be made from somewhere else. I think the indications from the government has been that they would look at budgetary savings, like the flagships welfare programs. There could be cuts there. There have already been efficiency measures. So the focus will not be that much on cutting subsidies, but it will be much more on budgetary savings to accommodate this additional spending requirements, but keep overall fiscal deficit in place. And I think that will be a very sensitive parameters for the onshore markets, especially the bond market as well as the currency.
Oh, thanks so much. Radhika Rao, the senior economist at DBS, there, joining us to look at the larger picture of what's happening in Indonesia's financial regulatory environment. Thanks for that, Radhika Rao there.